Good morning, everyone. This is Panakwan, and today I bring you again a very special Saturday episode of chemicals, why chemical stocks are a buy, and how it affects Strait of Hormuz, Iran, Israel, and all the US scenarios, right? So, what I have been talking about in my page is basically I have been bearish for a couple of months. You can see that I was talking about the oil market, and we were in week two. So when I say we were in week two is basically a buy, and that is buying on dip, which is happening. But ultimately, the main torture is going to start at week three when margin calls and market capitalization happens. I said that you should be buying at 650 levels, not right now, because the market is gonna see this very soon because the panic has still not happened. Everyone's buying on dip. That was the scene. But without further ado, let me introduce what is the most important thing. Yes, polythene or poly bags or plastic bags, whatever you call. Apart from the oil which runs the industry, the other major thing that the global supply needs is polyethylene. And everywhere it's used, whether it's packaging, your bags, automotives, car bumpers, headlights, construction parts, consumer goods, silicon, and healthcare. So, like each and every material that we have been using, like every Coke bottle that you have, all of them they need polyethylene. So polyethylene are the ones basically which affects each and every other country's well-being, and the market size for the global supply is like around 225 billion plus dollars, which is huge. So that's why I am calling a chemical stock play. So, the world's most critical oil choke point is what? That is Strait of Hormuz. You see that this is blocked. Above is Iran, below is Oman and UAE, and then we also have Qatar over here. And because of this being blocked, the major oil or crude cannot flow. So, what is crude? Crude is nothing, just a very raw product before the oil and all of these derivatives kind of come into picture. So, how is polyethylene made? That's a very bigger question. So, there are two different things. You can either make it from the crude oil or you can make it either from the natural gas. So, all of the supply which is happening. So, how do you make polyethylene? Crude oil. If crude oil is expensive, around 100 and $120, what's going to happen? Refinery, it's going to be more expensive. Cracking, it's going to be expensive. And finally, you are coming up with polyethylene, but it's going to be very cost heavy, right? So all of the Asian players, all of the Europe players who dependent on oil or LNG, they won't be able to make polyethylene. In the meanwhile, a US or Gulf Coast, which is on the west side, they do not deal with this problem. US have their own natural gas. They make everything from ethane, gas fractionalization, and then the cracking, and the following we get the polyethylene. So what happens when suddenly one part of the world has low cost and one part of the world has a higher cost? That's what the spread is, ladies and gentlemen. And when the spread is there, what people try to do, people try to capitulate on that opportunity. And US has been a capitalist nation all along, and they will definitely want to have the higher spread and make their margin. So that's what I'm saying, like 35 to 45% cost increase, right? And even if imagine like if I any US chemical manufacturer, if they are selling it at very low prices, I'm definitely from other parts of the world, I can pay for shipping and still get the product. So the spread is widened, so the margin is more that I can make. So who gets hurt versus who wins? So again, I have talked about this a lot. Asia and Middle East, they are struggling. I have already mentioned like what's happening. So LNG prices, they are soaring 80%, and Asian countries like Malaysia, India, Bangladesh, Pakistan, China, and all of these other countries need LNG because wider source of cooking is on gas prices over there. So there is a lot of things that are needed. And again, Qatar LNG, that has there was a event which happened, like a drone attack over there, so that was stopped. The crackers, they won't be able to make polyethylene because of such higher methanol or anything which is of higher cost. And similarly, European producers, like anything which is there, they have a lot of input costs. And then kind of a market reprices. So if you say about market repricing, here you go. This is a polyethylene index. You see, like from all the years, in 5 years, it was pretty consistent. That's why none of the production costs go high, right? Because as the humans are evolving, we see that we are making things at a rapid pace. They are heavy machinery, so that's why the cost is always on control, and it went down, and suddenly because of the war it's again spiking up. So what happens whenever that spikes? The whole the whatever we are talking about, the inflation is gonna rise. And polyethylene, over here you clearly see the chart what's happening. So I'm talking more in terms of polyethylene, but I will talk about the overall scenario, right, as well. So now with these three are the players on the US Gulf Coast, which actually wins? Dow. Dow is why the one. Dow is a very large company. LYB is also a large company. So what is EBITDA margin? So like when I'm saying 22% margin, that means every dollar that I earn, I keep 22 cents as profit before paying out for any of the taxes and other complicated stuff. So that's what it is. So they are going to increase the margin even more because of the spread which is there. Asian players trapped, they can produce polyethylene but are not that much cost. So that's the trade. So already analysts will keep on upgrading the cascading effect. Um, and it's also because one of the analysts will talk about it, then other will also notice, hey, even if this is the market, so unless people don't talk about it, other people don't notice. So once a person starts talking, a lot of analysts will come into this chemical sector, like the AI everyone has been talking about. They have bought the entire supply chain and the analysts are going crazy. But currently, because of the war, this is what the safe zone looks like. Dow, LYB, WLKP. So these this is some of the research that I'm showing. That's a buy. Earnings beat, again, high beta play. LYB, buy. Direct earnings beat. You can even look into all of those stocks and see how the market is kind of pricing them, right? And what is the risk? So risk is, one of it is US policy. Imagine if the export caps, like US said, hey, I need polyethylene, and I need to make a lot of manufacturing here, so you cannot export. If export does not happen, those margins cannot stretch or spread, right? So that is one of the thing, but that is low probability, mostly don't happen. The other thing is broader risk of tape. Imagine the crude oil is very high, but that brings in inflation. When inflation comes in, no one wants to buy stuff. They want to be minimalistic. And that's what stagflation is. And stagflation can cause this sector to kind of draw down and like fall further down. Other thing is demand destruction, right? So this is also kind of thing where sustained oil high demands, like because everything is very high, even the auto manufacturing, construction, consumer goods, anything which is linked to it falls down. So the demand kind of becomes very less. And the last thing is, which is rapid conflict resolution. Iran and US, like imagine that if they have any talks with Israel and they exit the war altogether, then definitely then the trade fails. Again, entry and exit, what to watch. You should buy this and keep on holding it till the time the oil is above $90, and also keep on tracking this index. If you see that polyethylene index is moving more above 10,000, definitely all stocks gonna reprice, because everything is driven by algo. Automatically, the hedge fund managers will start buying it. So that's it. That is another thing. They already have all of the data. So this all what I'm showing is just for the retail. Um, and then, so this is one of the thing. And then the exit triggers, again, as I talked about, the risk. If the demand falls, then there is a wider risk. And then you have key catalysts that you can watch is basically the Dow earnings are on April 23rd, and then oil prices definitely, and then polyethylene weekly prices. That's also a very big thing. And Hormuz status like daily is. So there would be some weekend operations. I feel that's also is going to be very big because it's a weekend, and I think some kind of a bigger action can take place before Trump goes on and meet President Xi in China, which is around the same time. So broader market, all the indexes of all of these indexes are going up. Let's see, if coal index is going up, this is coal index, this is steel index, this is lumber index, so this is soybean index, this is wheat index. So if all of these indexes are already going up, let's not talk about the natural gas, but all of these indexes, as you see, if everything is going up, how you can keep inflation down? There is no way. I 100% feel the Fed is going to be stuck between inflation and also how to keep the economy from crashing. So the coming Fed meeting, I feel, because Trump has already insulted Powell well enough, I feel it's again the conclusion which is going to happen is the market conditions. We don't know what's going to happen, so we are not doing anything with the interest rate. And if once that happens, we come to a wider fall. And I have talked a lot about this. So which is what week 3 and week 4 really happens. And that is the time when you buy. Thank you so much. See you guys later.